All right. Let's think about this for a second. Would you buy a dollar bill for 50 cents?
Hmm.
Seems kind of like obvious, right?
Right. I mean, who wouldn't?
Exactly. But here's the thing.
Yeah.
The stock market, it doesn't always follow that simple logic.
Right.
Sometimes you find these amazing companies that are basically, you could say they're on sale,
Yeah.
trading for way less than they're actually
Yeah.
worth. And that's where we get to this really interesting world of value investing. That's what we're going to deep dive into today.
Yeah, it's a strategy that some really incredible investors, I mean, guys like Warren Buffett,
Yeah.
have used to build, just massive fortunes.
Right. And it's not about like quick trades or anything like that. It's not about chasing the hot new thing. It's about finding these sort of like hidden gems,
Right.
these
Yeah.
companies with real value that maybe the market is just overlooking at the moment.
Yeah.
And then holding on to them while the market kind of catches up to what they're actually worth.
Right.
Kind of like buying that dollar bill, right?
Yeah.
For 50 cents and just waiting for everyone else to realize, hey, wait a minute, this is worth $1.
Yeah. Yeah.
So let's like break it down, right? Like, how does this actually work?
So at its core, value investing is about, like really carefully looking at a company's fundamentals.
Fundamentals. Okay. So when we talk about fundamentals, what are we even talking about?
Yeah, good question. So think about it this way. You're going beyond just looking at the stock price, right? You're really trying to understand, like, what are the company's assets? Like, what are those really worth? How much debt do they have? And like, most importantly, how much money are they actually making?
Okay.
That's what we mean by fundamentals.
So it's like looking under the hood, right?
Yeah.
Not just judging a car by its paint shop.
Exactly. We're trying to figure out, like, what is this company's intrinsic value? Like, what is the business actually worth? Which could be totally different from what the market is saying right now.
Right.
And, value investors will use, they'll use all sorts of tools to do this. Like, they'll really dig into balance sheets.
Mm-hmm.
They'll calculate something called earnings power value.
Okay, earnings power value. So what is that? Break that down for me a little bit.
Yeah, so think of it as like trying to figure out the true earning potential of a company.
Okay.
Like if everything was running perfectly right, how much could this company actually earn?
Mm.
And it helps us, cut through all the noise and like really get to like the core of what its long-term value could be.
So it's like almost like peeking into the future of the company's earning power.
Right, right.
And I'm starting to see how this is different than just like buying any cheap stock.
Right.
Right.
Yeah. And that brings us to like a really big myth that we gotta bust.
Okay.
Value investing, it's not just about buying cheap stocks.
Mm.
It's about finding something called a margin of safety.
Margin of safety.
Yeah, imagine that dollar bill again.
Okay.
You wouldn't just want to buy it for 50 cents.
Right.
You'd want to buy it for even less than that, right? To account for, like, what if there's something wrong with it?
Okay, so you're basically building in like an extra layer of protection.
You're right.
Just in case things don't go exactly as planned.
Exactly. And that margin of safety, it really helps protect investors from losing money, even if, the market kind of takes a dip. It's like that extra cushion that gives you a little more peace of mind.
Yeah. Yeah, I like that. Okay, so we've got the core mechanics here. But how do we know if a company is truly undervalued? Like, this still seems a little abstract to me.
Yeah, well, that's where things get really interesting, right?
Okay, so let's look at a real world example, right?
Okay.
So imagine this motel owner. We'll call him Papa Patel, right? And he came to the U.S. as a refugee with basically nothing.
Tough start.
Yeah, tough start. But during a recession, when everyone was like panicking, everyone's selling, he sees this unique opportunity.
Okay.
So motels are being sold for really, really low prices because, everyone's worried about the economy. They think no one's going to travel.
Yeah. So he's seeing a gap, right, between like what the market's afraid of and what the actual like value of those motels might be.
Exactly. He understood that like recessions don't last forever, right? People are going to start traveling again. And he takes the risk. He buys those undervalued motels. And when the economy recovers, he's built himself, a motel empire.
Wow. That's a great story. It really shows the power of seeing that value where other people just see risk. Right. And speaking of recognizing value,
Yeah.
let's look at maybe a more famous example.
Okay.
So Warren Buffett, back in 1973, he buys Washington Post stock.
The Oracle of Omaha himself. What did he see?
So he saw this company, with a powerful brand,
Right.
with huge potential for growth, but it was being like really unfairly punished by the market because of the Watergate scandal.
Oh, right.
And he buys it for like a tiny fraction of what he believes it's actually worth. And, as we know now, that bet paid off, big time.
Patience and long-term thinking. Yeah, that's classic Buffett. But sometimes it's not just like fear that's driving the price downs, right? Sometimes the market just like misinterprets the whole situation.
Absolutely. So let's talk about Stewart Enterprises.
Okay.
So this is a funeral home company.
Okay.
Not the most glamorous business.
Right.
But it's an essential service, right?
Yeah.
And so when worries about their debt levels start causing the stock to plummet, this value investor sees an opportunity.
Wait, so people were selling off stock in a company that deals with something that's always in demand.
Right.
That seems a little counterintuitive.
It seems illogical, but that's how the market can be sometimes.
Yeah.
So this investor, he realizes, the market's overreacting. The debt isn't as big a risk as everyone thinks it is. So they buy the stock cheaply. The company stabilizes, and their investment, goes way up.
Wow.
Yeah.
These stories are really like painting a picture here. It's not just about numbers. It's about understanding like the context, the psychology, and really the long-term outlook, right?
Absolutely, yeah.
But this all seems a little daunting, to be honest.
Yeah.
For someone just starting out, how do you even begin to find these hidden gems?
Well, it's not as overwhelming as it might seem.
Okay.
You can start by researching companies that you already understand, right? Like businesses you interact with every day.
So like if I love a certain coffee chain, or I always buy the same brand of shoes, like start there.
Exactly. Start there and look for businesses that seem to be out of favor, like the ones everyone else is ignoring, and there's even some some tools and resources that can help you. There's a method called the magic formula, which is basically a simple set of criteria for trying to find good cheap stocks.
So it's kind of like a cheat sheet for finding potential bargains.
Kinda, yeah. And it focuses on a couple of things, like return on capital and earnings yield.
Okay, so those sound a little complicated. Can you explain those like in simple terms?
Yeah. So return on capital, basically, that tells you how efficiently a company is using its money to make profits, right? So think about it like this. If you invest $100,
right,
you'd want the company to make more than just $1 in profit from that, right?
Makes sense. The more profit, the better.
Right.
Okay, and then what about earnings yield?
So earnings yield focuses on the earnings a company is generating relative to its stock price. So it helps you understand, is this stock potentially underpriced?
Okay.
Compared to how much it's actually earning. So
a high earnings yield could be a sign that the company is kind of a bargain.
Exactly. And of course, for a much deeper dive, there's the classic book, The Intelligent Investor by Benjamin Graham. Which is, kind of the Bible of value investing. Okay,
so we've kind of laid the groundwork here, right?
Yeah.
Value investing. It's about finding those companies where the true worth is higher than what the market is saying.
Right.
And it requires, like you said, patience.
Yeah.
A long-term perspective.
Absolutely.
And a willingness to kind of be different.
Yeah. Yeah.
But how do we actually put this knowledge into practice? Where do we go from here to actually find those undervalued companies?
Yeah, that's a great question, and that's exactly what we're going to explore in this deep dive.
Perfect. Let's keep going.
Yeah, it's, on Wall Street, it's so easy to get caught up in the hype, right? Chasing those trends.
Right.
People end up buying high and selling low out of fear, right?
Yeah.
But value investing, it's about taking a step back from all that.
Mm-hmm.
It's about being more level-headed,
Right.
less emotional. It's about looking beyond just the surface and focusing on those core fundamentals. Think of it like this. If you could buy this entire company, would it be a good deal at its current price?
Okay.
That's the kind of mindset you wanna have.
So it's like shifting from being a short-term trader to like a long-term business owner.
Right.
Really looking for that real value.
Exactly. And that takes a certain kind of discipline, right? You got to tune out like the daily ups and downs of the market and concentrate on the underlying strength of the businesses that you invest in.
But how do we as individual investors, how do we even like begin to evaluate that underlying strength?
So that's where the idea of an economic moat comes in.
Okay.
Now this isn't a literal moat, filled with water or anything like that. It's more of a metaphorical moat.
Metaphorical moat. Okay.
I'm intrigued.
So think of it as like a protective barrier, right?
That gives a company some kind of lasting advantage over its competitors.
Okay.
So it could be a powerful brand, right? Like Apple,
Right.
that commands customer loyalty, or it could be a cost advantage, like Amazon, right? With their massive logistics network, they can offer like lower prices than anyone else.
So it's about finding those companies that have that unique edge, right? That thing that really sets them apart.
Exactly. Companies with wide moats, they're like fortresses.
Yeah.
They're hard to attack. They can withstand competition, economic downturns, all sorts of challenges.
Right.
And that makes them, really attractive investments.
Okay. Finding companies with moats, that makes sense. But how do we gauge like the strength of those moats? How do we know if a company's advantage is really sustainable?
Right. Well, that's where, careful analysis comes in, right? We need to look at things like, market share. Like how much of the market do they actually control? Do they have pricing power?
Okay.
Like, can they raise prices without losing customers? How strong is their brand? And are there like big barriers to entry? Like things that would prevent new competitors from just coming in and taking their business.
Right. So you're really kind of delving into the competitive landscape, right? Like understanding the dynamics of the industry that they're in.
Exactly. And it's also about assessing, the quality of the management team, right? Like, are they good stewards of capital? Do they make smart decisions? Are they truly focused on creating value for the shareholders?
So it's not just about the numbers on a spreadsheet. It's also about the people who are actually calling the shot.
Absolutely. Great management can turn, a good company into a fantastic one.
Right.
While poor management can just completely squander even the strongest advantages.
Right. That makes sense. Let's go back to this concept of margin of safety that you mentioned earlier.
Right.
Why is that so crucial for value investors?
Right. So remember that dollar bill we were talking about?
Yeah.
So the margin of safety is like, it's like getting that dollar for even less. Like 40 cents, right?
Okay.
It's about buying a company for significantly less than its intrinsic value.
Okay. So it's like building in that extra layer of protection.
Right.
Just in case things don't go exactly as planned.
Exactly. Because no matter, how much research we do, how much analysis,
Right.
we can never be 100% certain about the future.
Right.
Unexpected things happen. Markets can be, totally unpredictable. And even the best companies can face challenges.
Yeah.
So that margin of safety, it helps protect us from those uncertainties.
I see how all these like pieces kind of fit together now, right? So value investing, it's about thinking like a business owner.
Right.
Finding those companies with strong moats, carefully analyzing their financials, and then buying them at a discount.
Right.
That margin of safety. But this approach, I mean, this requires this requires a lot of patience, doesn't it?
You hit the nail on the head. Value investing, it's a long-term game. It's about resisting the urge to chase, quick profits.
Yeah.
And instead it's about focusing on building wealth gradually over time.
Which can be tough, right? In a world that's all about like instant gratification.
It's true. It's easy to get caught up in the excitement of the market, but value investing, it's about staying grounded.
Right.
Sticking to those core principles and focusing on what really matters in the long run.
Okay, so we've talked about moats, margins of safety, being patient.
Yeah.
But how do we actually like put all this into practice?
Yeah.
Like where do we start looking for these undervalued companies?
So there's a few different approaches you can take. One is to focus on industries or sectors that are currently out of favor with the market.
Ah, so you're looking for like diamonds in the rough?
Exactly.
The companies everyone else is ignoring?
There's a saying in value investing, be fearful when others are greedy and greedy when others are fearful.
I like that. But how do we avoid falling into the trap of buying a company that's just cheap?
Right.
Not actually undervalued. Like how do we know the difference?
Right. Well, that's where, careful analysis comes in again, right?
Yeah.
We got to look beyond just the stock price.
Right.
And really dig into those company fundamentals.
So back to those financial statements, right?
Yeah.
Balance sheets, income statements, all that good stuff.
You got it.
Yeah.
We need to understand the company's assets, their liabilities, revenues, expenses, and cash flows. We analyze their profitability, their debt levels, their growth prospects.
It sounds like a lot of work, but are there any like tools or shortcuts that can help us along the way?
There are. Remember the magic formula we talked about?
Okay.
That can be a helpful starting point for finding, potentially undervalued companies.
Okay.
And then, for a deeper dive, The Intelligent Investor by Benjamin Graham, it's a must read for anyone who's, really serious about value investing.
Okay.
It outlines all the key principles and techniques.
So those are great resources for learning more, but finding those hidden gems, it still feels kind of challenging.
It's true. Value investing, it takes patience, it takes discipline, and it takes a willingness to think differently than the crowd.
Mm-hmm.
But the potential rewards can be, really significant for those who put in the effort.
Yeah. Okay, we've covered a lot of ground, right? Moats, margins of safety, long-term perspective, and the importance of really deep analysis.
Right.
Let's kind of shift gears now and talk about some practical tips for putting all this knowledge into action.
No.
Where do we even begin our search for these undervalued companies?
So one approach is to focus on companies that are overlooked or misunderstood by the market.
Okay.
So look for businesses that are kind of out of favor.
Okay.
Maybe they're facing some temporary challenges or some negative headlines.
So you're looking for those companies where the fear is outweighing the reality.
Exactly. There's another saying in value investing. It's a buy straw hats in winter.
Okay, I love that. I love that analogy. It's
Yeah.
about recognizing those opportunities when sentiment is low, when everyone else is selling.
Precisely. Another approach is to focus on companies that are undergoing some kind of change, some kind of like transformation.
So it's about spotting those situations where a company's kind of turning things around,
Right.
but the market hasn't quite caught on yet.
Exactly. It could be a new management team,
Yeah, right.
It could be a restructuring plan, a product innovation, or maybe a shift in the industry itself.
Okay, those are some great starting points.
Yeah.
But let's be honest, even with all this knowledge, it can still be kind of intimidating.
Yeah.
To jump into value investing,
Sure.
What advice would you give to someone who's just starting out?
So my advice is to start small.
Yep.
You don't need to be a financial expert or have this huge portfolio to get started. Start by researching companies that you understand, right? The ones whose products or services you use every day.
Right. That's great advice. It's about applying what you already know. Right.
Yeah.
Connecting the dots between your own experiences and the world of business.
Absolutely. Read books, articles, investment blogs.
Mm-hmm.
Follow the teachings of legendary value investors like Warren Buffett, Benjamin Graham, Seth Klarman.
So it's about becoming a lifelong learner, right?
Yeah.
Constantly expanding that knowledge.
Right. Yeah.
And refining those skills.
Exactly. And don't be afraid to make mistakes. Everyone stumbles along the way.
Right.
The important thing is to learn from those mistakes and just keep improving your approach.
All right. We've got the basics down, some practical tips, a list of resources to explore. But before we wrap up this deep dive, is there anything else you want to add? Any final words of wisdom for our listeners?
Yeah, I think the important thing to remember is that value investing, it's a journey, not a destination. It's a process of continuous learning,
right,
adaptation, and improvement.
It's about developing like a mindset, right? A philosophy, a way of looking at the world that goes beyond those daily fluctuations of the market.
Precisely. And it's about, having the patience, the discipline, and the courage to stick to your principles, even when everyone else is doing something different.
Okay, we've covered a lot of ground in this deep dive. We've talked about the core mechanics of value investing, debunked some common myths, looked at some really compelling real world examples, and discussed some practical steps for getting started.
Right.
But before we wrap things up, I want to leave our listeners with one final thought provoking question.
Okay.
In a world that's obsessed with short-term gains, could value investing be the secret to building lasting wealth?
That's a great question, and one that each listener will have to answer for themselves. But as we've seen in this deep dive, value investing, it's more than just a strategy. It's a philosophy.
Right.
It's a way of thinking, a commitment to understanding the true worth of things.
It's about recognizing that the market doesn't always get it right,
Right.
That there are those hidden gems out there waiting to be discovered by those who are willing to look beyond the surface.
Absolutely.
And it's about having that patience, that discipline, and the courage to stay true to your principles, even when the market is urging you to do otherwise.
Yeah, I think that's a great way to put it.
Okay, folks, there you have it. A deep dive into the world of value investing. We hope this episode has given you a better understanding of this time-tested approach.
Now it's your turn. Go out there and start seeking those hidden gems.
Okay, so we've talked about the mindset, some of the techniques, but I'm curious, can you give us like a concrete example of this patience and long-term thinking in action?
Oh, absolutely. Let's rewind back to 1973.
Okay.
When Warren Buffett decided to invest in the Washington Post. So the company's stock was trading at a pretty big discount,
right,
because of the Watergate scandal. Everyone was focused on that negative news.
So the market was kind of caught up in the short-term drama and missing the bigger picture.
Exactly. But Buffett, with his deep understanding of the media industry, he saw an opportunity that everyone else was missing. He recognized the strength of the Washington Post's brand,
right,
and its potential for growth. He bought a large chunk of the company, and as we know, that investment came off handsomely.
It's a classic case of seeing value where others just see risk.
Yeah.
But it must take some serious conviction to go against the tide like that.
Yeah, it does, and that's why patience is so essential in value investing.
Right.
It's not about getting rich quick. It's about slowly and steadily building wealth over time.
Kind of like planting a tree and nurturing it until it grows into something strong and magnificent.
That's a great analogy. And just like a gardener needs to prune away dead branches, a value investor needs to continually reassess their portfolio.
Right.
Getting rid of underperforming investments and adding new ones as opportunities emerge.
So it's a dynamic process, always researching, analyzing, making decisions. Now we've talked about finding undervalued companies in general, but But are there any like particular industries or sectors that value investors kind of tend to gravitate towards?
Yeah. So value investors often look for opportunities in industries that are kind of out of favor, right?
Okay.
So those facing, cyclical downturns or structural challenges.
So they're looking for those situations where an entire industry kind of gets painted with a broad brush, and good companies get unfairly punished alongside the bad ones.
Exactly. A prime example is the financial crisis of 2008, 2009.
Right.
Many banks were trading at extremely low prices.
Right.
Some were in genuine trouble, but others were simply caught in the panic.
So it was a case of indiscriminate selling where even healthy companies got kind of dragged down.
Precisely. And for value investors who could kind of separate the wheat from the chaff, right? Who could identify those genuinely undervalued banks, it was a gold mine.
Makes sense. Are there any other like types of industries that tend to attract value investors?
Yeah, they often look for opportunities in industries that are undergoing like major transformation or disruption.
So they're trying to spot those situations where change is creating new opportunities, but the market hasn't quite fully grasped it yet.
Exactly. Take the retail industry, for example.
Yeah.
The rise of e-commerce has really shaken things up, right?
Yeah.
It created huge challenges for traditional brick and mortar stores.
We've all seen that happening.
But this disruption has also, created massive opportunities for companies that could adapt and thrive in the new digital landscape.
Like those that embraced, online shopping, delivery, that kind of thing.
Exactly. So value investors would be looking for companies with strong management teams,
Right.
adaptable business models, and a willingness to innovate.
So it's not just about analyzing the numbers. It's about understanding the bigger picture,
Yeah.
how a company might evolve.
Right. You got to think about the long-term trends that are shaking the industry.
Right.
What are those forces at play that are likely to drive growth or decline in the years to come?
Those are crucial questions. So we've talked about industries that are kind of out of favor and those experiencing transformation. Any other like strategies that value investors use to find those hidden gems?
Yeah, one classic approach is to focus on companies with rock solid balance sheets.
Okay.
Meaning low debt and plenty of cash on hand.
So it's about finding companies that are financially sound, right? Able to weather those storms and seize opportunities when they arise.
Exactly. These companies, they have more flexibility, right? They can invest in growth, acquire competitors, or even return capital to shareholders.
That makes perfect sense. But isn't it possible that a company with maybe a weaker balance sheet can still be a good investment if the price is low enough?
That's true, but you got to be extremely cautious in those cases.
Okay.
A company with a lot of debt is much more vulnerable to economic downturns or unexpected problems.
Okay, so a strong balance sheet is generally a good sign. Are there any other like financial metrics that value investors tend to focus on?
Yeah, they often pay close attention to metrics like return on equity or ROE.
Okay.
And return on invested capital or ROIC. These metrics they measure how effectively a company is using its money to generate profit.
So they're looking for companies that are not just profitable but efficient with their capital.
Exactly. They want to see that a company can consistently generate strong profits and healthy cash flow over the long term.
So it's all about sustainable profitability, not just a one-hit wonder. This is really fascinating stuff. But it does seem like a lot of work.
It does take effort.
Yeah.
Value investing is not, a passive strategy. It requires research, it requires analysis, and a willingness to really dig deep into the fundamentals of a business.
But for those who are willing to put in the time and effort, the rewards can be substantial.
Absolutely. Value investing is about taking control of your financial future. And making well-informed decisions based on solid principles.
It's about tuning out the noise and focusing on what truly matters.
Right.
The long-term value of the businesses you invest in.
And it's about having the patience, the discipline, and the courage to stick to your convictions, even when, even when the market might be telling you to do otherwise.
We've covered so much ground in this deep dive. We've explored the core principles, the strategies, the mindset behind value investing.
Yeah.
Remember, it's not just about picking stocks. It's about understanding the true worth of things.
Absolutely.
It's about thinking like a business owner.
Right.
About seeking out those hidden gems, those companies that the market has overlooked.
Yeah. Yeah.
And about letting your investments grow over time.
Right.
So to all our listeners out there, go forth and invest wisely. The world of value awaits.
Absolutely.